Okay. My name is Mark Willis. I'm a Senior Policy Fellow at the NYU Furman Center, and as many of my friends say, a recovering banker. It's a pleasure to be here to talk about at least the initial impressions we have of the CRA, the new final rule for CRA. We heard a lot, I think, in the last couple sessions here on the perspectives of the banking regulators. And now we have an opportunity to hear at least the initial thoughts. I'm not going to ask everybody whether they've read all 1,500 pages, word for word, but at least the initial impressions people have of the new rules. So without much further ado, I'm going to open this up. All of the questions I have in mind here are for all four panelists, so hopefully they will even engage with each other a little bit in terms of what they're thinking and what they're seeing. So I'm going to start, and I'm going to sit down for this. How you doing, Lloyd?
I am well. How are you?
All right. Lloyd asked if I had in mind where he should sit, so I've taken that as an indication that he's probably the first person that is going to be able to comment here. So Lloyd, as we heard, the final rule obviously includes a lot of changes, or a number of changes from the proposed rule, and hopefully they have made it in some way more effective. We heard from the control of the currency, more, better, faster. We've heard achieving CRA's full potential. So from your perspective, I separated out the two bankers here, by the way. So from your perspective, yeah, that's another way to put it, Jesse. But from the perspective of a banker here, how do you think these changes have helped to enable and incent your bank to increase the impact and level of CRA activities?
So Mark, thank you for that question, and I'm about to get to it.
Okay.
But I'm going to exercise a privilege, and I'll do it quickly.
Actually, I should have introduced you. You're going to introduce yourself. Each of you can do that.
Okay.
Okay. Why don't you do that?
I'm Lloyd Brown with Citi, and I'm the Chief CRA Officer. But the privilege I'm going to take is first, I too want to acknowledge Buzz. Buzz, Jim, and I, and Mark have known each other over a quarter of a century. So we may take some liberties. At times, Jim and I, or I take the liberty of saying I'm Jim Matthews if I'm going to say something controversial. So we're going to have a little bit of fun. But Buzz, if my wife was here, she would remind me that in front of any putative successful man stands a woman. And so it would be only appropriate for me to also acknowledge Marilyn Rivera, our board chair, whose term is finishing, for her leadership and her work. So having said that, and let me get to Mark's question, and so I do want to make the point that I am providing my perspective and not of Citi's. Most of you that know me, I'm not shy, I'm a troublemaker, and likely to say some things that are controversial, and so I want to get that out the way. But I also want to acknowledge, and I mean this sincerely, I served as a bank examiner with the Federal Reserve Bank as a safety and soundness examiner for 8 years. I know the incredible work that the regulators put into the panel. All three that are up here are very thoughtful. They had a whole agency and staff behind them. I'm going to speculate. There may be, if there's such a thing as CRA post-traumatic syndrome, having worked on it for 10 years. But I would respectfully respond, Mark, by saying my overall challenge with the final outcome is that, as my graduate school taught me, you have to confirm the premise. Mm-hmm. And so one of the things was that banks were getting outstandings too easily. Mm-hmm. They weren't doing enough. Mm-hmm. And we want to force them to do more. Right. And I take issue with all those points. So while there have been some improvements, the improvements are not sufficient. Mm-hmm. I will boil it down to this. And I don't like using the term final rule. I think it's an obsolete term. We had a final rule that lasted for a year. So we call one rule the 95 rule. I'm going to refer to this one as the 23 rule. The rule, in my estimation, is not going to be durable. The rule is a compromise. And if I make an analogy with either brain surgery or heart surgery, where I split the baby and say, I'm 70% 30 right, you usually end up dead. Third, in terms of something that is critically important to me, helping low and moderate income communities, I'm not sure that it's going to achieve that objective. When I was a bank examiner, in some years I used to travel 23 weeks out of the year. I'd leave on a Sunday, come back on a Friday. There wasn't a branch in my community, so I had to leave Crown Heights and go to Park Slope to get cash. So that's very real to me.
Right.
Unlike some of you, I interact with poor people regularly. They're in my family, and at times I feel like I'm a poor person. So as a banker, I believe in the CRA. Citi supports the CRA. And let me also say this. Every time I speak, I check CNN before I go on the stage. There's an unflattering story about CRA today. As a designated CRA officer and senior officer of the firm, I take accountability. While I was not particularly involved with that, but we all try our best. I think the rule has some opportunities, and I'm going to pause with citing someone I've never met, but I would encourage those of you who have not had a chance to read Director Travis Hill's dissent. He's a director of the FDIC. I don't know him. I don't know any other things he's done, but I thought he had a very, very thoughtful dissent. And if you read it, you'll understand some of the points that I will make. But I'm going to pause right there because I don't want to be too overly complimentary, because in just initial thinking, Citi will spend $20 million on 1071 implementation.
And what's 1071? Everybody here probably
Small
knows.
business reporting.
Right. That's all.
And then on one aspect of CRA, we'll spend another $36 million. And if the rule changes within a year, those are funds that will not go to low and moderate income communities. So I want to make sure that it's right, that it achieves the objective. And my final point, the rule is neither clear or transparent in a number of respects. As someone I rely on from the ABA has pointed out, the analyses pages number 38 pages or so. I'm presenting to my board in 30 days, and I'm going to be asked the question, directionally, Lloyd, where do you think Citi will perform? And for the first time in my life, I'm going to say, I don't know. That's a career-limiting move, generally, but we don't have benchmarks. We don't have information. By the time we find out, it's going to be too late. And so, this flying the plane and fixing it and building it at the same time, I think is very dangerous. And I also think is very dangerous where we find ourselves. Sorry for that long-winded answer.
Well, after that optimistic point of view, Lloyd, well, thank you for sharing those thoughts, particularly so thoughtfully. Good thing I put somebody in between the bankers, not that he would be crushed. And Jesse can is more than well equipped to defend himself here and these things. So, Jesse, why don't you share with us what you think from your side, whether you're speaking personally or for NCRC?
Yeah,
about these
and I
rights.
will speak for NCRC. I think it's hard not to when you occupy a leadership position at an institution for your words to be associated with your institution. So I will speak on behalf of my institution. I will take a moment just to thank Buzz. I was really happy to hear Joseph say, if anything's wrong with the rule, blame Buzz, because a lot of people come at me and say, you're the well, now you know. From the regulators,
Perfect timing.
From the regulators themselves, blame Buzz. But also I want to thank Buzz for his contributions to the field, which people have already covered, but also for his contributions to NCRC. A lot of people don't know this. But Buzz was instrumental in NCRC's history. NCRC wouldn't exist today in the form that it is without Buzz. And now that you're retiring, we can say that out loud, and people can blame you for that as well. So I just want to thank Buzz for all of his contributions, as others have said. Just a legend in our field, a man for all seasons. I do take a very different view. And I was a little hesitant, a little nervous to be on this panel. I think there are two institutions up here who are most impacted by retail lending assessment areas. I think that shapes a certain institutional view of the rule. But I think when we think about more, better, faster, I think it's hard to argue that there won't be more. You certainly, I think it's important to study and measure. I think the agencies have done some of the best analysis of this. 10% of banks in the country would get a needs to improve if you just apply it backwards. I think it's hard to argue that it won't in some way incent more activity. Even just bringing people up to market averages will, I think, generally increase the amount of activity. And we're talking about billions and tens of billions of dollars, not tens of millions spent on the rule. So I think actually the impact and the consequences are significant. That's not to say necessarily that it will be better. I do think it will be better. I think there are some ways in which the rule has really sharpened our understanding of what qualifies the impact. I think people have focused a lot on the quantitative metrics as sort of, well, if you hit the quantitative metrics, there's a presumption of passing. I think actually if you're below the quantitative metrics, there's a presumption of failure. And what that means is, in fact, the entire game will be played and the debate will be something much more meaningful. Is it having an impact? That we can set aside the quibbles over what level of activity constitutes good or excellent, what meets the performance context. This sort of very unclear, well, you know, performance context said and penetration was good or excellent, to something much clearer. And in making that part of the equation much clearer, we can talk about what really matters. And what really matters is the impact it's having in communities. And I think where that focus will especially be acute is on the community development test. The point was made that on the community development test, perhaps the regulators punted. I tend to think it was more intentional than that, that indeed there's some examiner discretion, and the role of community input is critically important. So I tend to think that the metrics will be table stakes, and what will really matter, what we will spend our time arguing about going forward, is the thing we should be spending our time arguing about, which is it having the right impact? And how the impact factors get structured, created, how they get weighted, are critically important to CRA's success. That's not a written story. That's why it's so important that we remain engaged in the implementation process. But I also think it was intentional, what the regulators did, and I'm terribly optimistic about that. Whether it will be faster or slower, that's the one where I get, I'm not sure. I think it's very likely the case that it will be faster in some good ways, and also slower in some good ways. And so I don't know that I would make a judgment to say overall it will be faster. I do think it's the case when you think about it. I do think it's the case that overall this is going to have a positive impact. It's going to move the ball forward. We're optimistic. But it's, as Lloyd said, it's a compromise rule. We're certainly not totally thrilled. We think there are major shortcomings, most notably the failure to include race explicitly. But I think actually the product that has been created will endure for that reason. Remember, a number of Federal Reserve Board governors who were appointed by Republicans voted for this thing. the regulatory agencies, in their very nature, these are battleships. These are people who have worked at these agencies their whole lives. And be careful what you wish for, and be careful what you complain about. Because in fact, some of the things that are in the final rule were the result of complaining by the industry and the result of what we wish for by the industry. How that turns out, remember, there were protests in the streets that led to the creation of CRA. I'm not sure you really want to open up a popular debate about CRA, because I suspect you would end up with something much more significant than what we have today. I think, if anything, the industry should be very happy with the thoughtful, balanced approach the regulatory agencies have taken.
So Jesse, thank you very much. It's certainly clear why we wanted you to be on the panel. Apologize if you have to sit between two bankers, but I think you can hold your own. Certainly always have. And if you have a complaint, it's Buzz's fault. So. All right, so Jim, another very thoughtful member of NAAHL who has been, and this is Lloyd pointed out, around for a while. Why don't you share with us your perspective from your bank, which is, explain a little bit about why its particular perspective that you have.
So Jim Matthews, I am the Corporate CRA Officer for Capital One, and I have been in CRA for more than 35 years, so I have been around a little while. Unlike Lloyd, though, I don't have an attorney's training, which means I will not be talking as long as Lloyd was for my introductory remarks. And I would like to take bets on how frequently he's going to take my name in vain, as opposed to Jesse here. But I would say, getting to this issue of balance, one rule of thumb test that I would have is if Jesse and I were as equally pleased with the final rule, and alternatively, if we were as equally displeased with the final rule, then I would say, the banking agencies are probably somewhere in the right range, because that's how rulemaking occurs. We all know that. Nobody gets everything that they want from a rulemaking process. I think here, the agencies, I'll give them a ton of credit, and I really admire the work that they've done and the time and the effort that they've put into this, because as all of you know, CRA is a very, very complicated and highly nuanced activity. And to try to reduce it to a regulation, I'm surprised to some extent it was only 1,500 pages that they published. So from that perspective, I think they do need to be applauded for the work that's been done and their efforts. The other thing is they did take more time than we anticipated they were going to take. The early rumors were, this rule was going to be out by the end of last year. I don't know how that would have occurred. And then we kind of heard every quarter that it was coming out by the end of that quarter. So apparently, there was a lot of back and forth in the agencies trying to get to the final product. The other thing I'll say is they were highly responsive to a lot of the issues that were raised by NAAHL and in our comment letter. So there were a number of improvements. The 50-50 split, for example, was one of those key issues, which I think brings a little more balance to the examination and the way that this new framework actually operates. But I think there are two really significant issues where the mark was missed. And one of those is around the retail lending assessment areas. First of all, the thresholds. The way the thresholds are defined, it kind of seems a little arbitrary when you can go from one number to another set of numbers. which means at some point down the path, you could go to a completely different set of numbers. The reason I say that, and Mark, you alluded to this fact, but when you look at the number of banks that are impacted, in the proposed rule, it's 125 banks. In the new rule, it was half that number at 63 banks. When you look at the number of retail lending assessment areas that the agencies are estimating will be created as a result of the final rule, it's 863. You have 2 banks on the platform here that represent about 50% of those retail lending assessment areas. So it seems a little arbitrary from that perspective. And I wouldn't say that because we're a digital bank, because we're a hybrid, very heavy into digital, but it's really not the digital revolution that's pushing that. It's small business credit cards. And I believe the same is true for your institution as well there, Lloyd. So a small business credit cards, very easy for a high volume lender to hit that threshold of 400 of those little buggers. And
You
now,
used to speak more positively of them.
and
Technical term, right?
that is a highly technical term. You've not been in CRA long enough.
Yeah.
At any rate,
Actually, it's an acronym, but I forget what it's.
let's not go down that path, Buzz. But at any rate, you can see the issue because look at the dollar amount of 400 small business credit cards. You're probably talking, in many instances, in the neighborhood of about $8 million. So $8 million in lending triggering a retail lending assessment area. So the fact is, there's not a materiality level for one thing, even if you believe in the concept, which I never did, probably never will, not from a CRA perspective. I think there are better ways to do it than deposit-taking or deposit-based assessment areas or retail lending assessment areas. The other big issue that affects every bank that's going to be subject to the new rule is the fact that we don't have benchmarks for everything that we're going to be measured against. And it's not that we just don't have them, that they're unknown. It's also that they're unknowable. And that's because we're going to be measured strictly against market performance, more critically on the CF or the Community Development Finance test. And so it puts us at a huge disadvantage when we don't know what we need to aim for. So I'm going to leave it at that for now, Mark. But I did say I was going to be balanced. There are a lot of more positive changes that were made, but those are 2 big issues. And that second one actually is the reason that I would have the same response as Lloyd. I'm not sure whether we would be able to achieve an outstanding CRA rating as we have for the past 5 exam cycles, because we don't know what those benchmarks are.
Jim, you've raised a couple really good issues. We're going to come back to some of them, but one of them that we probably aren't going to come back, and which is because of the 2 of you bankers, is whether when, the regulation is as flexible as was said to deal with all different bank types. And for better or worse, I appreciate you laying it out, there are bank types that may be falling outside of, of the framework that they have, or having an unusual impact on those. Well, we now turn to Buzz, whose wisdom we've all followed here. Everybody else is talking about him retiring and how much we owe to him. Obviously, the opportunity really is for us to blame him for everything. And Buzz's commitment to this topic and this effort here is so clear by not only moderating 2 of the 3 panels, but subjecting himself to being on the 3rd one. So Buzz, do you want to talk a little bit about how you saw the changes that we've seen to the 23 rule, thank you, Lloyd, that contribute to this more, better, faster.
So I think there's no doubt we needed to have a new CRA rule. The old one was 28 years old, and communities and the banking industry had simply changed far too much in the interim not to have a new rule. And there have been efforts starting in 2010, which some of us remember very well, that one didn't really get very far off the ground. Then we had a very short-lived rule from the OCC, and even before that had been rescinded, Lael Brainerd at the Fed had the foresight to begin another process with the ANPR. That has culminated in where we are now. We had major concerns about the way the old rule was really standing up, whether you saw that on the retail lending side or particularly on the community development side, I think needed to be done. The retail side, I think it were maybe both of them, but particularly the retail side, had no publicly known methodology to it. And so I think, as I mentioned on the last panel, whenever it is you take something that is behind the curtain and therefore mysterious and unassailable, and you make it really explicit, the agencies are really making themselves open to all kinds of criticisms, many of which are fair, some of which are not fair. But that's just the way it goes in the policymaking biz. And I think on the whole, I'd rather know than not know. In terms of the proposed rule, we really had a threshold and very deep concern with the proposed rule. Our concern was that it would provoke a race to the bottom. And the way that would happen is by a combination of essentially two things. One is, because of the weighting very heavily toward retail, in order to be in the game for an outstanding rating, a bank would have to so far outperform the industry that it just wouldn't really be practical. And having failed to achieve an outstanding rating there, it would be impossible to get to an outstanding rating with community development, regardless of how much, or for that matter, how little community development a bank would undertake. And that, from my perspective, really posed an existential risk for the efficacy of CRA. This final rule is a dramatic improvement over that proposed rule in that threshold fundamental respect. So now we have a 50-50 weight between retail and community development. If a bank does outstanding work on community development, as I believe many banks have been doing outstanding work on community development, and I hope that will continue to be recognized, although it's true that we don't know exactly how that's going to work. In that case, a bank would have to achieve a high satisfactory rating in retail to get an overall rating of outstanding. Whether that metric is attainable or not, I can't say for sure, but I can tell you it's a lot more attainable than the proposed rule would have been. And I think it was really incumbent on all of us, whether we're community organizations or banks, to really dedicate ourselves to achieving outstanding performance. And not for the sake of the banks or community organizations per se, but for the sake of the people and communities that really need to be part of the economic and financial mainstream of this country, if this country is going to cohere. And I think this rule gives us a fighting chance to achieve that.
Right. Okay. Yes.
So Mark,
Brief.
first, you told our panel that we couldn't have any presentations, and all of the other panels had slides. And so I hate reading to
bring one?
people.
No?
I hate reading to people, and I hate being read to, but I think it's important to set the context. With regard to this notion of doing more, by objective measures, Citi has been the #1 affordable housing lender for 19 of the past 20 years, if not more. I have 3 colleagues in the audience who actually do the work. I'm not involved. We take a lot of pride in that. I say in CRA, and I take this from another colleague from Bank of America, we are co-opetitive. We cooperate with each other, and we're competitive. If we're producing that level of community development without the new rule, then the question becomes the so-called tailoring to different business models. And it's apropos that both Jim and I are here representing Capital One. So let me just give you some data points. Some data points. Based on the FDIC summary of deposits, so I like to have data-driven. As of June 30th of this year, there are 4,655 FDIC commercial banks in the United States. I'm going to focus on 2 data sets. Of those 4,665, 158 have assets of $10 billion or more. And so the new CRA puts a great onus on those banks. But you have to compare business models. Jim's bank and my bank, we lead in small business with small business loans that are average size 7,000. Jim's bank is out of the mortgage business. We are. But you have to look at the fact that Citi has 662 branches. Our average deposits per branch is $756 million. If you were to take the biggest bank, JP Morgan Chase, their average level of branch deposits are 435. It's a math test. And Wells Fargo, 435 billion,
right,
average per branch. So if you look at CRA as a measure of reinvesting in the community, the test cannot be tailored just by the math. Under the 95 rule, Citi has 33 assessment areas. With retail lending assessments, we add an additional 171. And with outside lending, we add another 280. Yesterday, a colleague told me we have 1 loan in the Marina Islands. No disrespect from anyone here in the Marina Islands. I remember hearing about it. I had no idea where it was. And so I'm concerned about the creep. We're going to start out, you have some obligation in retail lending. We may want you to have boots on the ground. We may want you to do grants. It creates an overreach. And I think you have to look at the business model of the bank. The fundamental problem, this rule, for the first time in CRA, will require banks to change their business model to work towards the rule rather than operating in the ways that we would do based on our own strategy.
Okay. Yes, right. And then I want to move on. I'm going to move on.
I think it's actually the opposite. I think it's the case that banks have changed their business model in ways that were harmful to communities, and there's now a recognition of that in the rule. So many large banks got out of FHA lending. That caused a harm to a lot of low and moderate income consumers. It dramatically reduced bank lending to low and moderate income people, and nobody ever got dinged for that under CRA. That was a business model decision choice that banks made that was incredibly harmful in the context of I know exactly why, Jim. I know exactly.
We're not having a debate here, Chip. Thank you.
So my point, though, is
it's an important
CRA,
point.
CRA, because of the Department of Justice lawsuits, but CRA shouldn't dictate business model decisions, but it should hold them in tension. When you make a business decision, it has implications. When you make a decision to build a nationwide lending business beyond the branch network, it has CRA implications. And the new rule, for the first time since CRA's passage, the new rule will look at every bank's lending comprehensively, all of it, between the facility-based assessment areas, the retail lending assessment areas, and the outside retail lending assessment areas. For the first time, you won't have this weird system where we're looking at it in some places and not in others. You're going to be evaluated. And it's not just It's not just Citi and Capital One. More and more banks will start to look like Citi and Capital One in terms of their digital channels. More and more fintechs will get into banking. This rule makes the CRA framework applicable to them in a way that levels the playing field across the banking industry. I don't think it could be possible that Chase's average branch has 456 million, perhaps.
Yeah, right.
Billion.
Can't be billion,
I mean,
because then they'd
million.
only have
I tried to get you, Lloyd.
5 or 6 branches. But I think the point still holds. I just wanted to. I saw Nikki make a face. I just wanted to.
I tried.
I blame it on Mark because I couldn't have my chart here.
I tried to help you. Go ahead, Jess. Are you done?
Yeah. That was my point.
Yeah, so we've covered a couple of different pieces here. I want to move on to another larger topic with a few minutes that we have. And that is the balance between quantitative and qualitative. So the quantitative is clearer, more consistent, even more transparent can be there. And that was clearly one of the goals here, right? And then there is the quantitative part. And do they have that? Those things are in tension, as it turns out. Do they have the right balance? And I think one way that I think about it, in part because of all the debate we had initially, Buzz, about retail test versus community development, you need to look at each test. So, clearly a responsiveness and impact is built into the retail services and product test, right? Seems to be built into the community development services and community development services test. Maybe it's built into the community development financial test. In fact, it is explicitly. I shouldn't have put it in that language. What about the retail lending test? Have we got the right balance there? I understand, separate from the issue of retail lending areas, although assessment areas, even though that whatever the balance or lack of balance applies in the retail lending assessment areas, just as it does in the facility-based assessment areas. I can see Jim. You want to just comment on that?
No, that's important. I think it's important even in the retail lending test because there's a huge difference. Let's say you have a mortgage lender that basically meets their targets doing just conventional mortgage lending. There's a big difference between that and another lender who is meeting their targets using highly specialized mortgage products that are targeted to LMI populations. There's a huge difference between those two.
And how does the rule deal with that?
I'm not sure that it does appropriately. It could come in, I believe, under the retail services and products test.
Right.
But
that's only 10 of the 50%.
Yeah. But my opinion is, Mark, that those types of things should be contained within the test itself.
Right.
When you're talking about the quantitative and the qualitative measures. Now, I did want to say one thing that I agree with Jesse about. I knew I would get him sooner or later, and it didn't take too long. I really don't think that there's necessarily a bad thing looking at the institution's performance in total, regardless of the geography. Where I see the difference, though, is having this layer in between with retail lending assessment areas. I think that's analogous to a branch in a county, and that county is your assessment area. So you're going to pick 3 or 4 neighborhoods in that county to draw your conclusions for the assessment area. I think when you're looking at the institution in total, that's going to tell you whether your digital channels in conjunction with your physical channels are appropriately serving LMI populations. You can get a pretty conclusive read from that.
I just want to help everybody here who hasn't read all of this. So you build the institution level on each of these different silos, right? The retail lending tests go up and the services and the CD and stuff. And what you're proposing, at first sounds like it's the same, but it's really quite different. It's to
is.
say, when we get to the institution level, I don't want to look at all of these in this silo. I want you to look overall. Are we doing
Right.
a good job?
There are just too many issues when you're arbitrarily picking markets here and there. I mean, there's another issue too, as I understand it, I might be wrong, but I think a bank has to designate these retail lending assessment areas on an annual basis, and the determinant being the prior 2 years. You're going to have, in my instance, and probably Lloyd's, you're going to have a number of markets that are going to come in and out. That's never how you do community development.
We have a very short amount of time, so
Yes,
I want
we
to
do.
skip ahead in the process, actually. The discussion earlier just seemed very important here about implementation, right? And there are a lot of aspects of implementation. I'm going to posit that there's Q&A, there's examiner guidelines. They talk about online tools. They talk about dashboards and all of that. How do you see this playing out in a way that helps to address the issues here, but also in the positive? How can that process best lead us to have more and better, even if not faster? So I'd like some thoughts here. Clearly, Michael Barr in particular, but others talked about the role of the community input. In fact, community input all the way through to the examinations itself. But there's obviously a role for banks, or a role that we ought to be asserting here of how important the banks are in that.
One quick answer
Right.
is examiner training. That's going to be the key thing, Mark, in terms of implementation. What a lot of people don't know is that in most of the agencies, the examiners who are responsible for CRA are responsible for a broad range of consumer compliance issues. It takes a completely different mindset when you're evaluating performance of the bank's CRA record. And with all of the changes that are occurring within this framework, there's nothing that's going to be more critical than making sure that you train and perhaps even have larger groups of specialized CRA examiners.
Jesse, what do you see the role here of the community?
Yeah, look, I think I want to acknowledge something, which is, I've argued for the final rule being clearer and transparent, et cetera, but I want to acknowledge something. When we talk about challenges and issues, just acknowledge that understanding the rule is complex. All right, that's true. By the way, the original rule is complex. If you didn't understand anything about CRA, you wouldn't be able to even read the updated rule, because CRA is complex to begin with. It always has been, and probably always will be. So understanding and interpreting the rule is complex. The implementation and transition is very complex. So I sympathize with my colleagues when they say, well, we don't know what we're going to get. It's sort of inherent to change itself. So it's a problem and a challenge. If you were to change the rule in any substantial way, either you would have the same problem, or you would have a very different set of problems. Say you set absolute metrics. Well, if you hit this number, there's big problems with that. Either you set the number too low and it's not effective, or you set it too high and it creates safety and soundness concerns. We've talked about that. The peer comparison is the best way to structure this thing. It creates some lack of certainty in the transition period. I think that what will happen is once the transition occurs a few years in, things will be much clearer and simpler, and that's what I'm arguing for. I do think that the training of examiners is critically important. I think developing the impact factors further, really, really important. And I think from the very beginning, Lael Brainerd said it in some of her early speeches, preserving the community input is part of that. I see it taking more form in the community development test than I do the retail lending test. I think the qualitative factors there, we argued for consideration of pricing and the quality of the product and other things that I think you don't see show up in the rule. I wish they had. I think it does come in the retail services test to some degree. I think you'll see some conformity and consistency there, hopefully, in ways that improve the quality of lending, but I think they could go further. But I really see it coming into play in the community development test, that how, because that is where there's some examiner discretion that's preserved. And I do believe it won't be just, if you hit the metrics, you're good. I think it really is going to measure, an attempt to measure something we all should be concerned about. What was the impact? Did it have an impact? And giving more weight to that. So I think that whole process, critically important and very difficult and hard and complex. And so I want to acknowledge the transition and change, which is inherent to changing the rule itself. I mean, if you want to argue against changing the rule at all, that's one thing. But almost any change you would make creates an implementation and transition challenge that we have to confront. And I think most institutions are going to confront that head on. Perhaps some will preserve other options.
So Lloyd, despite some pretty fundamental concerns you have, particularly on the retail side, are there things that you can see being dealt with in the implementation process that might be helpful here in terms of making it or allowing CRA to achieve the goals that we've talked about?
The implementation is going to be very, very critical. And so Jesse's comment about peer comparisons is important, but it's also comparing the right banks. John Olson's in front of me. There's a difference between a Goldman and a Citi. And so when we talk about peer comparisons, are we treating like institutions, not simply based on asset size, but by their focus? In an earlier panel in terms of CDFIs focus on different areas. Based on what I understood Jesse to say, banks shouldn't have that opportunity. And so the False Claims Act and the Justice Department getting ahead of HUD, banks made business decisions to exit certain markets where they weren't competitive, or the fintechs were doing a better job. And so, I will end with this. My mother taught me at an early age to keep my hands out of other people's pockets. And a lot of times when you talk about CRA, people who have not worked in banking, they're very smart, and have not had to balance the P&L, the compliance, the customer service, the client service, the cybersecurity, the AI, the research and development. You can afford this. It's not that simple. The deposits we have traditionally belong to other people, and we've got to be good stewards of those resources. I do want to acknowledge one point. Community impact is critically important, but there's a caveat. Just because there's a community need, the institution needs to assess whether it's the best fit to manage that need. And as the discussion into climate change, the government won't do it, so CDFIs and others have come in to do with climate change. Banks should play to their strength, not to the area that someone else wants them to play to.
Right. I just simply say, at least part of that, because we don't have time to talk about it, we need to look where the performance context can deal with part of that. And that's something that can be part of the training and the thing. Buzz, the last word here.
Well, we're running a little short on time.
Yes, we are.
All I can say is the work will go on for the next couple of years on implementation, and then beyond that, when this really does take effect. And so you can, by all means, blame me, because I'm not going to be around. And I want to thank you. Yes, you'll probably know where to find me. But I wanted to thank all my co-panelists and Mark for a very lively way to sort of conclude our CRA discussions today. And there'll be much more to discuss going forward.
More to do.
Buzz, you're a Harvard. You're a Harvard-trained lawyer, and I would just remind you that both resignations and retirement letters have to be approved. So I wouldn't leave too quickly.
So I think we're done. You have final remarks? Is there another?
I've got a few things.
All right, so everybody please stay at your seats, and thank again the panel.
Too late.
Well, you've been a very attentive audience, and I know we all want to move ahead to relax and have a drink. We will do that in a little while, but since I am retiring and this is my last NAAHL show, I did want to have a chance to say a few things. First is, it's been a wonderful honor and pleasure to serve NAAHL over the last 9 years. I'm so proud of our members. Our members deliver more than $200 billion of financing for low and moderate income people and communities every year. That is an unbelievable achievement. I also want to thank the NAAHL board that has indulged me for my time here, and particularly to Marilyn Rovira, our wonderful board chair. She's been a tremendous source of support and guidance, and it's really, it's one of the things that an association executive, lives and dies by, is how strong and supportive the board is, and I couldn't have asked for anything better. Thank you, Marilyn, and also to thank Jack Markowski, Marilyn's predecessor, who couldn't be here today, but was also a terrific board chair. And I also want to thank Nikki and JP Morgan Chase for being our lead sponsor today. John Olson, who led our conference planning committee, and it was a real substantive, engaged committee. Thank you again, John, and thanks for helping to raise all the sponsorships here you see. Thank you all the sponsors. Also must thank the mighty NAAHL staff, Sarah Spofford and Cherie Sinclair. The way they put together this conference is only indicative of the great work they do every day. So they too have made my life here at NAAHL really great, and I couldn't have done it without their collegiality. Thank you both, Sarah and Cherie. The theme for this conference has been New Ways Forward, and we've heard from a lot of different perspectives. We heard from Senators Cardin and Young about community development tax credit legislation. We heard from 4 inspiring leaders in the national CDFI scene about their vision for where we are as a field and where we need to go. We've heard about new climate resources that we can use not just to make housing more efficient, but to also help save the planet. We've heard about strategies to preserve affordability at scale, because that is a massive and very urgent challenge that we need to face if we're going to achieve our mission. And we've heard a great deal about CRA today from the agency principals and the staff and the stakeholders as well. We need new ways forward because we are, as was discussed at some length, particularly on the Community Development Financial Institutions panel, we are at an inflection point. Certainly with respect to CRA, we heard a lot about implicitly the inflection point that this new rule represents. It's also, though, both a moment of opportunity and in other ways a very daunting time. As we've also heard, the housing affordability crisis is affecting more people in more places than ever before. Meanwhile, the task of developing affordable housing and operating it effectively is much more challenging because of rising costs, higher interest rates, and the like. I'd say that increased partisanship is making it harder for Congress to do its work, to write legislation. And for that matter, harder for the executive branch from administration to apply policies in a consistent way. We all need consistency so we can get our work done effectively. I'd also say that macroeconomic policymakers too often fail to take housing affordability seriously. I think we saw that in whether you call it the Great Recession or the financial crisis or the housing crisis of the first decade of this century. At the time, leading officials said, well, you know, these foreclosures could hurt some consumers, and that would be a shame. But it wouldn't really have much an effect on the economy as overall. That was wrong. And then they were surprised that when necessary work to stabilize the financial system was criticized and opposed, maybe because the commensurate work wasn't being offered to help struggling homeowners. And we see it now. We see it now when housing costs are a primary source of inflation, but the policy solution to inflation is to make it impossible to expand housing, to alleviate that cost pressure and inflationary pressure. That's just, I believe, a misunderstanding of the role of housing affordability in our nation's economy. I think it's central, and I think we need to be much more sophisticated about how we see it. We're also, at an inflection point on racial justice. And we've had some setbacks with the Supreme Court. I know NAAHL is committed to racial justice, and I think we all need to continue to move forward very strongly to ensure that this country serves all its people and includes them. And finally, maybe most fundamentally, Annie Donovan, I think, talked a little bit about this earlier today. Political and social divisions are just making it harder for all of us as a country to come together and work together, trust each other, hear each other, so that we can move forward as a country. In our local communities, we see this as NIMBYism. This is not a partisan thing, that we see liberal and conservative NIMBYism alike. So how do we keep forward? Well, how do we keep moving forward? First, we all should agree that America does better when everybody, every community, and every person in our country does better. We're all in this together. We can't move forward together unless we all move forward together. And that is sort of a fundamental choice that we have as a country have to make. I think we've been losing our way in this regard, and we need to get back on track. Second, we have to keep playing the long game. Affordable housing and community development take a long time. It takes a long time to stabilize and revitalize communities, or to build affordable housing. Maybe too long, but we do have what it takes. We've got the vision, the commitment, the persistence, the resiliency, and the adaptability to get it done. It does require execution capacity, it requires scale, and it takes partners, and it takes leaders. And I think everybody in this room and all the organizations that you represent play an absolutely fundamental role in that partnership. We need you all to keep it going, to make it stronger, to do more. We can do more. It's going to also take a lot more resources to get it done. We've got some new resources, particularly in the climate side. We've talked about the low-income housing tax credit today. Congress has not permanently expanded the low-income housing tax credit since 2000. It's been 23 years. In that time, we've seen a tremendous intensification of the housing affordability crisis we face. We've got not just the low-income housing credit, but other policies and resources that we know work. We have to tell that story much better to policymakers, to the media, to the general public. Our story is a great story, but hardly anybody hears it. I don't want to be too pessimistic about that because I think that's getting better. I think there's a much greater public awareness of the affordable housing challenges that we face. We see this in polling where there is overwhelming public support, bipartisan support for expanding the low-income housing tax credit, for enacting the Neighborhood Homes Investment Act, and doing other things as well to address some of these challenges that are really affecting not just poor people, not just poor communities. Maybe some might marginalize them as not that important, but it really is affecting the entire country. And we need to really take it on much more seriously. And we're starting to see it. I mean, you saw Senator Cardin, you saw Senator Young. They don't have to do this, and yet they've made it a priority. And there are others as well. Senator Cantwell is another great example of that. And we make our fight on solid ground. We've got a great track record. The low-income housing tax credit has produced 3.7 million affordable apartments. That's more than a third of all apartments that have a similar affordability in this country. That's an amazing impact, but we need to do much more. The New Markets Tax Credit has generated more than $200 billion in private capital for communities, and leveraging that up probably 8 or 10 times in terms of overall impact. The CRA, I think, has had an incredible positive effect for our people and our communities in our country. The CDFI fund has helped to grow CDFIs into a major industry. And so taken together, these policies and investments comprise a system unlike any other this country has seen, and I would posit that any country in the world has developed. So we do know what to do. We just need to do more of it. And that's what we have to commit ourselves to do. And so I hope you all join me in that commitment. And with that, I want to thank you and offer to pour you a drink.